I'm going to start the webinar now. So please kill your cameras, except for Dean Sonobe. So good morning, everybody. Thank you for joining this book launch today. Firstly, I would like to introduce Dean Sonobe, who will provide some opening remarks to this event.
Okay. Thank you, John. Good morning, everyone. This is Tetsushi Sonobe, Dean of ADB Institute. It's my great pleasure to provide some opening remarks for this book launch event. The book is entitled Macroeconomic Stabilization in the Digital Age. It's published from ADB Institute, so it can be downloaded freely. First of all, I'd like to congratulate the two co-editors, Mr. John Beirne, a research fellow at ADB Institute, and Mr. David Fernandez, director of Boon Institute for Financial Economics, Singapore Management University. And authors who will speak here are Professor Yiping Wang of Peking University, Professor Hans Genbach of Asia School of Business, and Professor Muhammad Zubair Muntas of National University of Science and Technology, Pakistan, and the other authors of chapters. I think that this is the first book that John has published. Am I correct? Well, it is the first or second,
Correct.
or even 20th. All writers love the happy period of time after completing the book draft to little after the book launch, including the moment when he or she chooses the design of the book cover, the moment which I cherish particularly. I would also like to express my thanks to the participants in this event for your interest in the book and the compassion towards the young co-editors. The project of publishing this book started before I joined ADB Institute. I heard that it began last year with the Boon Institute for Financial Economics at Singapore Management University. A conference where papers were presented took place in Singapore in October 2019, which means that it was in the conference was in a physical format. It had very interesting discussions, face-to-face discussions on aspects of digitalization pertinent from macroeconomic policy making perspective. Today, we are launching the book in the virtual format, which is fitting with the broad theme of the book, namely digitalization. I'm very excited that this new book sheds light on a number of important issues that are relevant to policy making in the digital age. As we know, the ongoing shift to the so-called digital economy has accelerated over the past decade or so, particularly in the area of payment systems. While these innovations have, of course, helped to promote greater financial inclusion, the questions arise as to whether there are regulatory vulnerabilities and associated challenges for macroeconomic and financial stability, and what is the implication for traditional macroeconomic policy tools. This book provides both a global perspective and vivid portraits of the development in Asia and Asian economies. I look forward to the discussion by the book's co-editors as well as the panel of the chapter authors. I conclude my remarks by congratulating John, David, and other authors again. Thank you very much for your attention. John, over to you.
Thank you very much. I'm just sharing my screen. Sure. Can you see my screen?
Yes.
Yes.
But please make it bigger.
Okay.
Perfect.
Okay. So thank you very much for these opening remarks, Dean Sonobe. We're delighted to have this book launch today. It's been a process which began just a little over a year ago, a joint venture between the ADBI and the Simkey Boon Institute for Financial Economics at SMU in Singapore. I'd just like to present a few slides to provide an overview of the book and then promptly move to the discussion by the panel of book contributors. So just briefly, before I describe the book, let me tell you that you can already download the book itself since yesterday, I believe, using the link provided in the slide at the bottom of the page there. In terms of the book itself, there are three main parts. Part one focuses on digital finance and the macroeconomy. And this is set against the context that, you know, we've had a shift in financial intermediation away from traditional banks, and with financial services increasingly be provided by the non-traditional sector. And while this is, of course, very important in terms of financial inclusion and associated regional development, this can also create some vulnerabilities at the systemic level. And this is obviously a challenge for policymakers to deal with. So the chapters that comprise part one cover issues related to digital transformation and the implications that this has for macro policymakers, as well as some country-specific studies related to China and India. The second part of the book looks more at the issue of capital flows and systemic risk and how these developments have progressed, particularly over the past decade or so. Of course, we've observed reductions in cross-border transaction costs in the era of digitalization, but there are also vulnerabilities related to this linked to exposure to negative spillover effects. And the second part of the book has a number of chapters that deal with these issues. And finally, part three of the book looks at the issue of macroeconomic uncertainty. Of course, in the digital era, there's large degree of uncertainty, particularly in relation to the speed of the innovation that's taking place. And there are associated challenges for central banks in this area, particularly in relation to the monetary policy transmission mechanism. And we have a few chapters in this part of the book that explores these issues in more detail. So that's the overview of the book, three main parts. As I said, there are a number of chapters within these parts of the book, both at the broader global level and also some country-specific studies that look particularly at economies in Asia. That's the table of contents. And finally, once again, as I said, the book can be downloaded using the link provided at the bottom of the page there. So without further ado, I think this is a good point to move to the panel. Hans Gendberg will discuss his chapter in greater detail for around 10 minutes. And he will talk about digital transformation and some of the implications that this has for macroeconomic stability as well as financial stability. So Hans, I turn the floor to you now. Thank you.
Thank you very much, John, and thank you, John and David, for including me in this project. John, can you stop sharing so I can share my screen, please? There we go.
Go ahead, yeah.
Yeah. There we go. So my chapter is called Digital Transformation, Some Implications for Financial and Macroeconomic Stability. And I basically talk about 4 issues in the chapter: implications for the financial system and financial stability, digital transformation of the payment system, of course, an important issue that is much discussed these days with the introduction in some countries of digital payments forms and central bank digital currencies and the like. Third issue is macroeconomic consequences of digital transformation. Digital transformation in this area will lead to, likely lead to changes in the economic environment that central banks are facing, which means that they have to adjust their strategies and operations accordingly. And finally, I talk a little bit about in the chapter about the possible implications of the coronavirus pandemic on the issue, the previous issues. And the point there is that behavior of all of us has changed during the coronavirus period, partly in response to directives from governments that ask for different measures of lockdown, but also just because we are changing our behavior in relation to the health risks that we may be facing. And those behavioral changes may very well become ingrained and permanent in the system, and that may change the economic environment more in the longer term. Today, in this brief remarks, I will speak about the first of these topics in a little bit more detail. So, what is it about digitalization that is particularly pertinent to the financial sector? There are two aspects to it that I think are important. One is what is called big data. The other one is data analytics. Big data refers to the collection of and storage and use of data, which contains literally tens of thousands of observations from bank customers in the context of finance, holders of insurance policies, issuers of users of online payment platforms and the like. And this massive amount of data, if properly analyzed, can be used by financial institutions to provide new services to their customers. Now, but it's difficult to analyze very, very large data sets. And this is where machine learning and artificial intelligence comes in. This referred to various types of sophisticated methods to discover very intricate and deeply embedded relationships in these big data sets, and relationships which are valuable for the institution in terms of, again, the financial services industry, when it comes to credit worthiness assessment, asset allocation, and the like. So these are parts of digitalization where the financial sector can use methods to expand their services to customers. So the question then arises, is this something that is going to threaten the traditional financial institutions because newcomers are coming into this area? Well, of course, the newcomers are the fintech companies in particular. There have been a very large number of startups in this area, and using these tools and data sets in their operations, again, providing services that are useful for customers in the case of the successful startups. So does that mean that the traditional financial institutions, the commercial banks that we're used to, will be competed out of the market? Well, not necessarily, because traditional banks are also embracing these methods, the data sources, the analytical methods, and they can relatively easily incorporate some of these innovations introduced by fintech companies by replicating the work these fintech companies are doing, or simply by acquiring these companies and incorporating them into the organization. So by itself, the widespread digitalization of finance is not at first sight a threat to traditional banks. But there is a but. And that is the challenge from what is called big tech. What is big tech? These are companies such as Alibaba, Tencent in China, Amazon, Google, Facebook, etc. in the US, Uber in Europe, and Grab here in Southeast Asia, where I'm located. These are traditionally not financial services companies. So you might say, well, why should they be a challenge to traditional banking services? The reason is that they are able to gather huge amounts of data due to their vast network of customers in their other business lines of business. And they are increasingly using these, and I think we'll probably hear from Yiping, that particularly in China, this is the case. They're using these data to provide financial services by offering credit, insurance product, asset allocation services, et cetera, to customers. Now, again, this benefits customers and presumably also the shareholders in these companies, but it does present a challenge for traditional financial institutions which do not have access to the same customer information base as the big tech companies have. And therefore, the traditional banks cannot easily replicate the services that the other companies are able to provide. And also, the big tech companies are just simply too big to be bought up by the banks. So there is a challenge for the banking system, traditional banks in this sense. There is also, as a result of especially of big tech companies coming into this area, there are financial stability, potential financial stability impacts and therefore required regulatory responses. On the financial stability side, the emergence of new financial products and new financial services providers is similar to financial liberalization, which we have seen over decades coming up in various parts of the world, in Latin America, in Europe, in Asia, and so on. And sometimes these financial liberalization episodes have led to financial stability, dire financial stability consequences. The reason being that the new products have unknown risk characteristics. They can have unknown risk characteristics. And also, it is not clear what the systemic consequences of big new entrants in the system are. How will the entry of big tech companies, for example, impact the dynamics of the financial system? The second point about financial stability is that the new analytical technique that are used may lead to herd-like behavior of the system as a whole. Because to the extent that they rely on similar techniques, these analytical similar techniques are used across the financial institutions, then the solutions these techniques come up with are going to be similar across institutions and possibly creating greater procyclicality in the system because they all act in the same way in response to news. And also, if the outsourcing of the artificial intelligence functions lead to a reliance of many traditional financial institutions on just a small number of artificial intelligence companies, then there's possibility of a single point of failure risk into the system. And many traditional smaller financial institutions will have to outsource these functions because they're typically too expensive to build yourselves. So the regulatory issues then is that since the financial services provided by unregulated non-financial institutions are often very much the same as the services provided by regulatory entities, then there is a risk of regulatory arbitrage as deposits flow from traditional banks into the big tech companies, for example, which have different regulations. And that implies that regulators must be aware and take appropriate action. And the typical suggestion is that regulation should focus on the activities of a bank, for example, deposit taking, rather than the institutional structure of the bank itself. So this is a very quick review of the first topic, implications for financial system and financial stability. As I mentioned, in my chapter, there's also a discussion of the transformation of payment system, the macroeconomic consequences and consequences for monetary policy, and the implication of the coronavirus pandemic. I'm afraid you're going to have to read the chapter if you're interested in those topics, and I hope you do so, as well as reading the rest of the book. If you want to talk to me virtually, here's my email address, and feel free to send an email with comments, suggestions, and so on. Thank you very much. That is all from me. Thank you. You're muted, John.
Thank you. Thank you very much for these insights, Hans. I think the issue of regulatory arbitrage is particularly pertinent. And indeed, you have a lot more information in your chapter, so I would encourage people to have a look at that chapter in our book. Moving swiftly on to Yiping Huang, who will discuss fintech in China and its implications at the macroeconomic level. So Yiping, over to you. Please go ahead.
Thank you very much, John. And again, I would also like to thank you for including me in this wonderful book. My chapter really highlights the development of the fintech sector in China and the implications for macroeconomic stability. What is really happening in China at the moment, especially in the financial industry, is quite exciting. You look at the new digital technology, especially the big tech platforms, the AI, the big data, cloud computing, and so on, really changed in many ways the financial institutions conduct the businesses, especially in the area of financial inclusion, particularly for SMEs and for individuals. So just in summary, the big tech platform is able to reach massive number of customers because of the so-called long tail feature of the big tech platforms. Just give you an example, for instance, Alipay now has 1.2 billion customers, and WeChat Pay has 800 million customers. That just changes the way the financial services reaches the customers. But at the same time, big data, AI, and cloud computing allows very rapid but also individualized services delivered to their customers. At the moment, if you look at China, for instance, the mobile payment is already widespread, but we're also seeing the rising big tech credit, the digital insurance, the online investment, and in fact, the central bank is going to quickly rule out the central bank digital currency, what we call digital currency, electronic payment, and so on. In the tech space, landscape. One example, was very difficult for the traditional financial sector institutions to reach these the small enterprises, especially these in the Western region, in the remote area, and in the rural areas. But now, if you have a smartphone, if you have a telecom signal, you can almost enjoy the same kind of financial services as people live in the urban areas. So this is why I think it is a revolution. That's my first point. The second point, then, I also want to discuss a bit about the implications for macroeconomic stability. I mean, I agree with James about some of the potential concerns we have to look at. But for the moment, I also like to highlight some of the impact that the technology is having on the macroeconomic stability, and I'll give you 3 examples. The first example is what happened during the COVID-19. When we were hit by the pandemic, offline businesses all slowed down or even completely shut. But what happened was online activities picked up. And you look at, for instance, the e-commerce, online teaching, entertainment, and so on. These became much, much more active. This is what I call the so-called macroeconomic stabilizer. Digital technology, digital economy, and digital finance. They're all playing a very important stabilizing effect. That probably is a useful feature to have, but particularly valuable at the time when we are having this pandemic. In fact, in May, my institute, the Institute of Digital Finance at the Peking University, co-hosted a conference online with IMF to look at what the big tech credit is doing during the pandemic time, because around that time, most of the traditional banks also closed their business. But these new online banks continue to serve their customers, and the so-called contact-free transactions became extremely valuable. That's the first thing I like to highlight. The role of macroeconomic stabilizer, especially at the time of pandemic. The second possible impact is from our observation of looking at the volatilities of inflation in China. So if we look at, for instance, the producer prices and the consumer prices, you would find that the producer prices are always very volatile. But there was a turning point around 2012 and 2013. Before that, in fact, the CPI was equally volatile as the PPI. But after that, the CPI became very stable. We look at that phenomenon, and we did a study just to show that the main reason why suddenly inflation volatility substantially reduced was because of the rapid development of the mobile payment and associated e-commerce. The e-commerce essentially integrated the whole country into one market. Now, to be sure, China was one market, but because of the information asymmetry, because of the transportation costs, the regional markets were probably segregated in one way or the other. E-commerce changed that. And that's why suddenly you have a much more deeply integrated one market, and the price volatility was substantially reduced. So the second example I like to share with you is that digital technology could, in fact, improve macroeconomic stability in the example I just mentioned. The third example, this is a result of a study we did with economists at the Bank of International Settlement. The big tech credit James mentioned earlier is already becoming a mainstream phenomenon. Well, not a mainstream, but it's a growing phenomenon in China. A lot of big tech companies doing it. The banks also trying to emulate it, and even smaller banks trying to follow the model by using the data that the government integrated together. But anyway, bottom line is traditional banks utilize the collaterals to make loans to SMEs. But these new type of loans relies on data, big data, not on the properties to extend the loans. This changes what Bernanke once called a financial accelerator in the older regime, when the loans are all based on collaterals. There is an internal relation between the credit policy and also property prices. When the property prices decline, credit squeeze, which could lead to a further decline of the properties. So that's why in an economy with a financial accelerator mechanism, a small step decline in property prices could lead to end up in a financial crisis or economic recession. What we did with BIS economists was using Ant Group's online credit data to look at the elasticities of the credit with respect to the local property prices. If we look at the commercial data, commercial banks, traditional commercial banks characterize the credit data. The elasticity was 0.6, which basically means if the property prices declines by 10%, credit would be squeezed by 6%. This was what Bernanke called financial accelerator. However, if we use the online bank data, what we found, the elasticity was insignificant, almost zero. That certainly means this one mechanism, one channel of financial instability is taken out. So these are some of the effects we assessed in our chapter, and these are the issues I think we all needed to look at. But again, I think James was right. While there are some positive impact from the digital technology and the fintech on macroeconomic stability, there could be at the same time some potential risks and the downside effects we also needed to look at the same time. Thank you, and back to you, John.
Thank you very much, Yiping. Some very interesting insights there from the perspective of China. Notably that, you found that inflation volatility has actually decreased due to digitalization and enhancements in digital payment systems. And of course, this is something which has accelerated in the COVID-19 period. Of course, when we began this project, we did not have COVID-19. So it remains to be seen whether further growth in digital payments and advances there will lead to even further benefits from a macroeconomic stability perspective. So yeah, thank you for those insights. Moving on swiftly to the next presentation by Dr. Mumtaz. This is closely related to what Yiping had been talking about, in fact. But this presentation will look at the implications of fintech for monetary policy effectiveness across a sample of advanced and emerging markets. So over to you, Dr. Mumtaz. Thank you.
Thank you, John. Honorable Dean and CEO, ADBI, co-editors of the book, and participants, good morning. I congratulate ADBI and simply Boon Institute for Financial Economics, SMU, for the successful launch of the book. And I will be presenting whether fintech activities affect monetary policy in this chapter. Over the last decade, the emergence of new technologies has posed serious threats and challenges to the structure of the financial sector. The evolution of electronic money, digital banking, crowdfunding platforms, and distributed ledger technology raises various concerns for the banking industry and macroeconomic policy. Fintech innovation has tremendously changed the accessibility of financial services. For instance, a peer-to-peer lending permit customer to get funds in the absence of a banking channel. A new mode of payments, for example, mobile softwares, allows people to transact through a smartphone, and distributed ledger technology, for example, blockchain, facilitates new means of reporting and executing transactions. These developments have started to influence the ability of central banks to conduct monetary policy effectively with the goal of financial stability. The emergence of technological innovation in the financial sector affected the dynamics of businesses as well as the banking system. Digital currencies are used as a model of modern technology to transact business, which may affect the demand for and the supply of money. To raise this concern, it is important to analyze how markets are reacting to fintech instruments. This chapter examined the impact of fintech on monetary policy in developed countries. In this regard, we took 25 developed jurisdictions and examined the impact of monetary policy before and after the initiation of fintech activities. We addressed 4 important questions in this study. First is that money in circulation and money multiplier may have effect before and after the fintech activities. Second, we examined that the effect of monetary policy and fintech instrument on the money demand. and the output gap. And lastly, we examined that the different drivers of the fintech instrument, that actually what are basically their factors that actually they are being influenced of those factors. This is an overview of fintech. The fintech is generally referred to as portmanteau of financial technology, which is characterized by the financial services of the 21st century. Initially, innovation process supported and recognized consumer and financial institution eventually turned into a full-fledged process of creating digital currencies. Though there are various negative concerns associated with the cryptocurrencies, fintech products affect the sale of banking products by satisfying customer desires using the instant process and greater customer positioning and speed up the process of innovation. Previous studies emphasize that there is a complicated relationship between the central banks and its ability to implement monetary policy and the different suppliers of money or credit, which generally influence the supply of money or credit throughout the financial system. This is an overview of the digital currencies. The 4 digital currencies we have used in the studies. Bitcoin is the oldest currency, launched in 2010 and 11. And then we can find out that the volume and the trading volume of the Bitcoins is much higher as compared to other currencies. In this study, we took 4 digital currencies, Bitcoins, Ethereum, Litecoins, and Ripple. Beside these digital currencies, we took mobile internet technology and observed that what would be their impact on money demand and output gap. Digital currency is a broad term that can contain anything that digitally represents value. Digital currency can contain what we would call electronic money, which is simply a digital representation of government-issued fiat currency. It can also cover virtual currency known as electronic currency that is not considered legal tender. So we addressed the 4 questions and determined that result report that trend of income velocity and money multiplier are the same before and after the fintech instrument. So we can find out that money in circulation and money multiplier still have no effect in the presence of fintech instruments, but as and when these activities will surge in the market, there's a probability that money in circulation and money multiplier will be affected. But at present, due to a lesser volume of the fintech instruments, these money in circulation, money multiplier have no effect on the after the initiation of fintech activities. Next, we find that real interest rate inversely influence the money demand, which suggests that the decrease in interest rate generate business opportunities. Whereas we also find that interest rate and output gap have an opposite relationship, which shows that a decrease in real interest rate reduces the cost of borrowing, thereby increasing the output of the economy. Mobile and internet technologies directly associated with money demand, which suggests that the digital transaction provide opportunities to flourish. Among digital currencies that we used in this study, Bitcoin is the only determinant that inversely and significantly influence money demand. This evidence shows that people are using Bitcoin as a mode of conducting their business transaction, which restrict the possibilities of transacting in cash and eventually reduces the money demand in the economy. We also find that mobile and internet technology negatively influence the output gap, and the coefficient of Ethereum is positive and significantly affect the output gap of the economy. However, digital currencies have no significant relationship. The last part of the study is that we determined that what are the different factors that can cause fintech instruments themselves, and then in almost all the cases we found that interest rate, GDP, inflation, financial development index, and stock market indices are the lowest factor. So we conclude here that at present the fintech activities are not affecting the money supply and the money in circulation, but still we can perceive that they may have effect in future. Likewise, the money demand and the output gap may be affected either positive or negative. They may have effect in future. That's all from my side. Thank you very much. Thank you, John.
Thank you very much for your presentation. Some very interesting remarks there, and I think that we still have a lot to learn in terms of the effect of fintech on monetary policy effectiveness, not least related to the relatively short sample period that we have available for the fintech period, but certainly some interesting findings there on the role of cryptocurrencies on money demand. So yes, at this stage, let me ask Dave to introduce the Q&A round, and we will take it from there. Thank you.
Thank you very much, John, and I want to thank the panelists for the three panelists for their very excellent presentations, and I hope that all of you hearing what our panelists had to say, it's whetted your appetite to download the book and to take a deeper dive into these important topics. I just want to first say, before I open up the Q&A and invite formally for questions, what a pleasure it's been for us here in Singapore at the Simkee Boon Institute to work on this project together with our colleagues at the ADBI in Tokyo. While we are based in a university and therefore embedded in academia, our mission at the Simkee Boon Institute is to bring together the best ideas with practitioners, in particular with policymaker and private sector, financial sector practitioners, to highlight topics which we believe are of practical relevance for industry and for society as a whole, and therefore the topic of this book, Macroeconomic Stabilization in the Digital Age, is certainly very relevant. You heard from Yiping about some of the positive aspects that it's bringing, including to macroeconomic variables like inflation, the centrality of this for digital finance, that is for payment systems, which Dean Sonobe talked about, central bank digital currencies, which Hans and others spoke about, but also the risks to this, the progression of fintech and digital finance that society as a whole is becoming more aware of. Certainly academics have been aware of this, and I would highlight the first chapter in our book from Prof. Josh Eisenman from USC in his excellent chapter where he notes the double-edged sword of digitization and fintech and the growth of natural monopolies we've seen in the US. The leaders of big tech firms that Prof. Hans spoke about being asked tough questions, and there's wider awareness clearly of the risks of this in society. I mean, just think about the Netflix documentary Social Dilemma, which is so popular and talked about now. So lots of very important topics that we handled, and it really was a pleasure to work on this project together with Dean Sonobe, John, and the ADBI. So let me get out of the way now and open it up for you to ask questions. There is a Q&A box for you to use, and thank you for putting a number of the questions. Let me start out for Yiping, a question on China and measuring and ensuring macroeconomic stability in China. What indicators would you say must be analyzed if we want to conclude that that there is stability or for that matter instability for the country, and on the contrary, how in general in this pandemic what do you think about China and other developing countries? Are they really ready to face conditions due to, if maybe they have limited access to technology, human resources? What recommendations do you have?
You mean what indicators should we look at?
Yeah, we start with that. What in terms of whether or not this is adding or subtracting to macro stability?
Well, the macro stability indicators most people focus on, and these are what I look at, is basically the growth volatility and the inflation volatility. So these are the key indicators I look at. At the same time, you could also look at the financial stability numbers and so on. So I think these are just the conventional set of indicators. In terms of what happened during COVID-19, I think the first key measure that helps with macroeconomic stability is effectiveness of controlling the pandemic. If you're able to put that pandemic under control quickly, then economic activities could rebound and stay on the track as before. So I think that's the most important number one measure. Secondly, if we're looking at the technological measures, in the case of China, as I already said, the digital technology definitely helped to support the macroeconomic stability in a number of ways. Number one, this digital technology certainly helped to control the pandemic. We have this, everybody has a so-called health code, on electronic health code on their mobile phones, which basically means it's easier to track if they confirm the case and to quickly stop the spreading of the virus. So that's the one thing I think the digital technology really helped. The second thing was, even if there was a lockdown or social distancing, the digital technology also helps to stabilize economic activities by boosting these online businesses, which I thought was a very important macroeconomic stabilizer. But obviously, there are still some potential downside risks, especially in relation to people who do not use these tools. So for instance, during the pandemic time period in China, there was a big story in the news. There was an old man who wanted to take a subway, but he was prevented by the staff because he failed to produce this electronic health code. Later on, they worked out this paper form, but for quite a while, it was difficult for people without access to technological tools to live like the other people. So they were in one way disadvantaged by this digital technology. So these are the issues I think we should also look at. A final word, looking at, for instance, whether or not the pandemic might change the way the fintech or digital technology affect the economy. We're looking at, for instance, when we did a study with IMF looking at the effectiveness of the so-called big data credit risk assessment models, and the people all become very interested. However, one question people often raise is, well, this model works well in normal times. What if the financial cycles turn, and when you have an exogenous shock, would this model still work? I think this is an issue we need to look into, but what we're seeing now, the preliminary evidence is that the MyBank, which is affiliated with the Ant Group, their NPL ratio already peaked in July and start to decline. And part of the reason why this is working is because the big data analysis, when they do the credit risk assessment, they look at two things. Number one, they look at more updated information. Therefore, they could look at the real-time data. The second thing is they also look at the behavior variable compared with the usual focus on the so-called financial data, which are significantly lagging when the banks look at them. These two kind of information have a serious significant advantage of better predicting default. And that's why we are seeing, in fact, the big tech credit, the quality already peaked, the quality already bottomed and start to improve. In a way, you could say they already overcome this pandemic and return to normal life cycle in terms of the quality of the credit, the bank credit.
Thank you very much, Yiping. Hans, you wanted to add something, and then after that, I'll ask Peter Morgan to ask his question. Go ahead, Hans.
Just briefly on indicators and on macroeconomic stability. From an international perspective, the World Bank has recently done some work on the correlations of business cycles across countries, which seems to have come down in parallel with a relative decline in global value chains. So, and that relates to the pandemic, to the extent that the pandemic will lead to structural changes in the production chains, then maybe there will be less cross-country sort of spillovers of policies, and is something that I think is worth monitoring going forward as well. Thank you.
Thank you for that, Hans. Ikuma-san has told me that there's been a hand raised, and that's I should have mentioned that's another way for you to ask a question. You can type into the Q&A, or you can raise your hand. So can I ask Peter Morgan, who's raised his hand from the ADBI, to ask his question?
Yes, thanks very much for very interesting presentations and an extremely useful book. My question is for Yiping. I just wondered if you could give us some indication of the scale of fintech lending in China, let's say relative to more conventional lending or as percent of GDP.
Well, they're still very insignificant in terms of the proportion. What I think is happening is a couple of things to note. If we're looking at at the moment, we're probably talking about 2%, 3%, definitely less than 5%. But this is growing very rapidly. That's the first point. The second point is these are very different kinds of credit at the moment. The customers they serve normally are quite small. And the loan amount is also excessively small compared to the usual commercial bank credits. So for instance, my bank's average loan is something like 30,000 yuan, which is very, very small. And also their short maturity, like 1 month, 3 months, 6 months, 1 year. This was probably one of the reasons why the NPL ratio already peaked with these banks, because their adjustment is much, much faster compared to the traditional banks. But the final point, I think, is that this big tech credit approach is not just limited to the big tech companies. So for instance, my bank, which is affiliated to the Ant Group, was collaborating with more than 100 commercial banks during COVID-19, extending massive amount of loans to the SMEs. That is significantly expanding the businesses. Even the banks themselves start to trying to emulate the same practices, because they also have their data, different kinds of data. Local governments like Guangdong provincial government and the Zhejiang provincial government also trying to put together, integrate the government source the data to help the financial institutions to extend the loans to SMEs. So this is really a growing business. But I think the most important story, exciting story, is that number one, these big tech lenders are reaching a massive number of customers that were never served by traditional banks. This is what I call financial inclusion. The second point is we never have seen a service at a scale and a speed like this. For instance, my bank has this one business model called 310 model. Essentially, a potential borrower can apply for the loan to fill the material information online within 3 minutes. The money will be in your account within 1 second if approved, and there's no human intervention. My bank, WeBank, and XW Bank, these are the 3 new type of internet banks. Each employs less than 2,000 employees, but it extends more than 10 million loans every year. So I thought that was a very exciting. But come back to your question, the overall portion of this big tech credit is still relatively small. Nevertheless, China is already the biggest big tech credit lender in the world, according to BIS data.
Thank you. John, should we go to other questions in the Q&A, or should we go next?
Yes, please do that, Dave.
Okay, so maybe I can, there's a question, John's already typed a little bit of an answer to it, but maybe I'll put it out there for the panelists and maybe ask Professor Zubair Mumtaz to take a first crack at it, and other of the panelists might want to do that as well. The question comes from Dr. Rahad Sikdar. How does fintech or digital economy help the developing and emerging economies to adjust their existing semi-skilled or unskilled infrastructures? Again, how does it protect the rights and interests for the beneficiaries in third world countries? So maybe Professor, if you can start with that.
Yes. Yes, fintech activities can help for the third world, the developing countries. But again, there is a question mark that the fintech activities are restricted by, if we talk about the fintech activities, that is the digital currencies only, that are restricted by the central banks of the developing and third world countries. But overall, we can say that the fintech activities talk about the mobile and internet technologies that actually boosted the output in the countries, and they can be helpful for because these technologies, mobile, internet, are available everywhere, and every small and medium enterprises can take the benefit. But again, it all depends upon that this fintech is not limited to one thing. It actually associated with different factors. It all depends upon the macroeconomic factors of a country, that what would be the potential of the country, and then we can find out that these factors can lead and help the output of the country by using these fintech instruments. But as far as the question is concerned regarding the digital currencies are at present, they are more familiar in developed markets. But over the time, it is hoped that these digital currencies will be useful. Cryptocurrencies are the digital currencies that we have, can be useful for the developing markets as well. Thank you.
Thank you so much. Why don't I turn it back over to John?
Yes. Thank you, Dave. Thank you for the questions that we've received as well as the answers, which were very useful. We have a number of other questions in the Q&A that I see, and I'm also conscious of the time, however, that we will not be able to go into detail with these answers. But if I just quickly go down through the questions myself and attempt to give a brief live answer, I'll do that for the next 1 minute. So there's a question by Proung Sopheep, I hope I pronounced it somewhat correctly, about a new project in Cambodia to stimulate fintech and digital banking called Bakong. I'm not familiar with that particular project, but of course, projects like these and developments such as these are typical of what we're seeing across not only Asia, but also the world. So we will look out for how that project develops over time and the impact that it has, not only on social inclusion, but also from a regional economic development perspective. There are other questions about illicit cash flow and digital health and other regulatory issues, which we touch upon in the book. As I said, we don't have time to go into detail with answers now. But I would say that all of these questions are well taken, and I would encourage everybody to A, look at the book, and B, send emails to the authors of the books and myself and Dave, should you have any further questions that you wish to ask us. At this point, I would like to hand back to Dean Sonobe, who may have a closing remark for us. Thank you very much.
Thank you, John. Yeah, so the discussion, presentation were excellent, and the discussions had very nice questions and very nice answers. I learned a lot. Yes, so ADB Institute will continue to work on the development of digitalization in the finance and the other aspects of the economy. So please join us more in the future. Thank you very much. Yes, John, back to you.
Thank you very much. Can each of the panelists please open their video screens? Yiping, can you open your video? So yeah, with this, we close this book launch. Thank you very much for all of the attendees. And we hope that we have provided some good insights into this important topic. In the current COVID-19 world, of course, digitalization is progressing faster. And we look at how this is impacting upon the economy going forward. So thank you very much. And that's the session closed.
Thank you.